Hi, today we're going to continue our discussion of stratification. Last time we laid out some of the basic concepts and definitions and looked at the conflict and order theory. Now we're going to spend some time looking in detail at the extent of stratification in the U.S. So here are the questions that we're going to be dealing with. First, what is the extent of stratification in the U.S.? And second, how have structural changes in the economy affected class structure? Over the next couple of lectures, I'm going to be looking at wealth, the middle class, and poverty. In this lecture, we're going to be dealing with the issue of wealth. Now, before we begin, I want you to make sure that you have printed out the slides and the lecture notes that I provided for you. I'm going to be showing you several charts. You probably won't be able to see any of them really well on your screen, but also I'm going to be providing for you any updated statistics and figures in your charts. So make sure that you take a look at those charts, get them off the WebCT site, and have them in front of you as you're talking. And I will be making some notes on those to help guide you through any changes that we may see. But it is the case that the trends that I'm going to be talking about are long-term trends and not really subject to that much change. So today we're going to begin applying some of the basic ideas that we talked about last time. And I'm going to be inundating you with facts and figures. Again, I will indicate to you the key things that you have to remember and the key points that you need to know. First, I have for you a sort of a visual image of what the distribution of income in the United States looks like. Here on this first slide is a poster that was designed there where each figure represents a certain number of the U.S. population. And we have distributed here an income, and I'm going to turn on the little pointer here, goes all the way from 0 to $10,000 a year, $20,000, 30, 40, and on up. The highest income up here is $125,000 a year. So each figure on here represents a household. The stripes are all based on their occupations, which is not so important right now. But what I do want you to see, median income is right around here. That is, right here is the middle level where half of the population earns more and half of the population earns less. As of the last, between 2000 and 2003, that figure was hovering around $42,000 a year. And as you can see, half the population down here earns a lot less money. What's kind of interesting, this is actually a chart, a poster-sized chart. If you were to put that up on the wall about eye level, an income of $300,000 a year, which I don't know about you, but when I got out of college, I thought I'd be making that in no time. If that was true to scale here, that would be about 8 feet up off of this chart. And if you earned $1 million a year income, that would actually be 3 stories up. So the distribution of income in this country is really highly skewed. So the first group I'm going to be talking about here is actually the upper class, the group of people that's not even on that chart. They're like the ones that are up 6 stories up. And there are 3 points I'm going to be making about the upper class. That is, one, that wealth and income is concentrated in the hands of the few, and you'll be seeing a number of charts and statistics to back that up. Second, that this gap between the rich and poor has been increasing dramatically. In other words, the rich are getting richer. And third, the U.S. has one of the largest gaps between the rich and the poor of any industrialized nation in the world. All right, let's start off talking about the rich. The first thing that we have to understand when talking about the very wealthy upper class is that there are 2 different ways of measure that becomes kind of important. First of all, there's wealth and income. Wealth is the sum total of everything that you own: stocks, bonds, land, factories, cars, that whole gamut. And income is what you actually earn. For the upper class, wealth is really the key understanding of how much they actually have and how much power. And when we look at the distribution of wealth in this country, we find that the richest 1% of the population own more than the bottom 95%. the richest 1% own more than the bottom 95% of the population combined. Even in terms of stocks and retirement benefits, it's the wealthy that own the vast majority of stock ownership. And most families don't even own any stock whatsoever. Furthermore, what becomes important, especially later on, we will see that debt, the individual debt, has meant that the rich's wealth is getting even farther away from the middle class as their wealth is actually really declining. So the rich are getting richer is the second major point about this. And if you take a look at this slide, what this shows right here is changes in average household net worth. Between 1983 and 1998, these trends have been continuing over the past several years. During this time period, the bottom 40% of the population, 40%, actually saw their wealth declining by 76%. At the top end, the top 1% of the population saw their wealth increase by 42% in that time period. Again, as I said, debt and consumer debt, credit cards, has really impacted the middle and lower class, but the rich are certainly getting richer. I have another chart here that I'm going to show to you, and that is every year Forbes magazine does the richest 400. If you want to go on Forbes magazine and online and check out their lists, you can see the richest 400 corporations as well as the richest 400 individuals. I've been keeping track of this for a while, and what we see is that in 1983, the combined worth of the richest 400 was worth $210 billion. When we look 20 years later, the combined worth of the richest 400 is almost $1 trillion. I can tell you when we look at these increases here, the rate of inflation has not increased as dramatically as the wealth of the richest 400 here. The richest person in 1983 was an oil magnate, Gordon Peter Getty. A few years later, Sam Walton. And then finally in 1992, and for the last 10 years, Bill Gates, the owner of Microsoft Corporation, has been at the top of being the richest person in the United States. Now, this tells us something actually really important about where wealth is coming from. As I'll be talking about later on, we're undergoing a transformation from a manufacturing to a service economy, where it used to be that most of the jobs and the wealth were in the manufacturing, and Getty was one of those examples of that. Sam Walton is the head, and his heirs are still very wealthy today, created Walmart, classic retail outlet, making lots of money, and Bill Gates, of course, Microsoft, signaling the importance of not only service but an information and computer economy. And he's been dominating this scene since then. The poorest folks down at the bottom, I feel so bad for them, only making $125 million in 1983. By the time we get to 2003, the poorest was only making $600 million. Sorry about that, $600 million. I want to say a couple things about Bill Gates. In these last years, there have been stock market crashes and stock market increases. During 1998, when the economy was doing really well, Bill Gates made about $1 billion every 8 days. He has more wealth than the bottom 45% of households combined. However, he lost a whole lot of money during 2001. He lost a total of $283 million during the stock market crash. Now, not to say that money is not important, but a lot of it is on paper, and when we look at the very richest people, their wealth goes up and down, but the impact on their fortune and their life chances is actually much less significant than it would be for one of us if we were to lose a proportional amount of money. Now, the other point about this that I wanted to make was that from the rich's net worth is going up at a pace far outpacing inflation, even far outpacing the stock market. The net worth of the richest 400 is up 423% between 1982 and 2002, and up 10% alone from 2002 to 2003 at a time when the rest of the country is in a slight recession. The Standard & Poor's stock market index during that time period was only up 353%. So the rich at the very top level are getting much, much richer. Even in terms of income, the rich are getting richer. If you look at this next slide and any of the others that I may have in your packet, we find that change in after-tax family income between 1979 and 2000, the bottom 20% only saw an increase of 9% in their income, whereas the top 1% saw an increase in income of over 200%. So the rich are getting richer in terms of income as well. One of the most interesting things that has been getting a lot of attention lately is CEO pay. That is how much the heads of these corporations are actually making in terms of income. And we can look at their pay over the last several years and find that their pay as well as skyrocketed. Between 1990 and 1999, CEO pay has gone up 535%. You see it's this blue line right here. Whereas the Standard & Poor's index, again, has gone up around 300%. Corporate profits, interestingly, have gone up 116%, while a worker's pay has gone up 32%, and inflation has gone up 27%. So as you can see, the CEOs are making a whole lot of money. Between 1999 and 2003, some of the statistics are showing that CEO pay is actually starting to decline. I think there's been a lot of attention with some of the scandals among large corporations about the amount of money that they're making, so that they've actually gone down somewhat. We also find that CEO pay is not correlating with the profitability of the corporation. Some of the highest paid CEOs preside over some of the least profitable corporations. I have another slide here that shows that in 1980, the average CEO made 42 times more than a factory worker and 38 times more than a teacher. By 1992, CEO made 157 times more than a factory worker and 113 times more than a teacher. By 1999, the CEO made 475 times more than the average worker did on the average. So the rich are getting richer at this really high level. Now, the next question that we have to ask is, what is going on with this? Why is it that the rich are getting richer? Well, it's important to see this not just an issue of individual greed, but some of the structural things that have gone on in our economy and political system lately. One of the first things that impacts the very wealthy, that's been a trend that is going on for a while, is tax benefits that are for wealthy and for corporations. Now, I want to make it clear, this is just not something that just depends on whether there's a Republican or a Democrat in office. But this is a trend that's been occurring in the last several years over the long run, because our society, as our political economy as a whole, has made a set of decisions saying that corporations and rich individuals, if we give them tax breaks, it will somehow trickle down to the rest of the economy. I have another slide up here that argues that from the 1940s, you'll see that here is the corporate share of federal tax collections, and the really dark line is the tax share that individuals pay. Well, from the 1940s down through the 1990s, the corporate share has continued to go down. They used to pay over 30% of all tax collections, and now they're down to paying around 10%, while the proportion that individuals are paying has continued to go up. And this has really benefited the wealthy class and far more than it's benefited the working class. There's been a lot of attention in the last couple of years to the presidency of George Bush and his devotion to tax reductions. And it is clear that his tax cuts are predominantly benefiting, or designed to predominantly benefit the very, very wealthiest of individuals. The idea is that if we give these folks the tax breaks, that it will help our economy as a whole. For whatever reason, that certainly has been the trend over time. The second reason why the rich are getting richer is a shift in investment choices between buying and selling corporations. There's been a major move to how the kinds of investments that we're making. In recent years, there's been a huge merger boom, corporations buying each other out, buying and selling other corporations, such that mergers occupy more economic activity than actual production of goods do. There are a lot of tax benefits to buying companies out that I'll talk about in a second. And certainly we've gotten to the point where companies are buying each other out at a fast rate that we may not even have a Fortune 500 corporations in a couple of years. Now 1% of all corporations account for about 80% of total output. And 1% of corporations control 2/3 of corporate assets. The second part of this is the notion of downsizing. That is when a corporation buys out another one, they end up firing a lot of workers, making the corporation leaner and meaner to a certain extent. This has proven profitable for corporations, but it has increased this gap between the rich and the poor. Actually, CEOs of corporations that announced layoffs of 1,000 or more workers in 2001 earned 80% more on the average than executives of the average firm. So if you lay off workers, you're proving to your stockholders that you're serious about profits, and so they tend to increase your wages. Certainly downsizing is key. And then third thing that has impacted this element of rich and poor in terms of investment choices is the financial advantages of debt. When you, any of you who are homeowners know that the money that you borrow to buy a home is tax deductible. You don't have to pay taxes on that. Same thing is true for a corporation. If a corporation borrows money in order to buy out another corporation, they don't have to pay income taxes on that. So there's a great deal of tax advantages to buying out other corporations. What this means is that deal making and buying and selling each other out are really having a huge impact on the nature of the economy. Corporate debt has gone up a tremendous amount in the last number of years, such that now corporate debt is around $5 trillion or 45% of GNP. So certainly buying and selling corporations is now taking on a major role in our economy and is certainly benefiting the richest of the rich. The third element that I want to talk to you about briefly here is that there are structural transformations that are going on in the economy that are lowering labor costs and increasing profits. Your book talks about globalization. It talks about transformation from manufacturing to service economy. The key point about these is that what they are doing is reducing labor costs for corporations and increasing profits. So the beneficiaries are the stockholders and the CEOs. The people who lose out are those that are at the bottom, the workers. But I'm going to spend a little bit more time talking about these structural transformations in the economy when I talk about the middle class. That's my basics on the wealth distribution in this country. Next time we'll talk about the middle class and poverty.
If you are interested in any other UNLV distance education course, please call us at 702-895-0334.